Hi everyone, welcome to this session of the Tiger Academy, risks that must be avoided when investing in US stocks. In the last lesson, you learned how to potentially sell your stocks to a buyer at a better price by using 3 classic technical indicators, and this showed the potential trading signals that you could take into consideration. Today, let's consider that while you may be on a winning streak in your stock market, your good friend Jack may suffer significant loss in investing in precious stones. It makes you wonder, if the price of those precious stones is so low, why is he losing so much money? To a certain extent, there is a type of investment in the US that shares some similarities to investing in precious stones. They are called penny stocks, which you can usually buy for a few pennies. If the share price of one of those companies skyrockets one day, you can get rich. But if the company fizzles and gets in any serious trouble, your investment may be worthless. Penny stock speculation is known for its low stock price and its high risk. Number 1, the risk of investing in penny stocks. Some investors would be curious, why would anyone go out of their way to buy such ultra-cheap junk stocks? Why not buy well-known companies like Amazon, Apple, and Tesla? That brings us to 2 ways you can profit from penny stocks. The first way to make money with penny stocks is related to the delisting system for stocks in the US. According to Nasdaq's delisting standards, if a stock price falls below $1 for 30 consecutive trading days, the delisting procedure will be triggered. At that point, a company has 180 days to improve the situation. For example, by maintaining its share price above $1 for at least 10 consecutive trading days, or face delisting. In order to avoid delisting, the company must find a way to raise its share price, for example, from 50 cents to more than $1. Although that will mean the stock price rises only by 50 cents, that's an increase of 50%. If it rises to $2, it will be equivalent to gain of 300%. The second way to profit from a penny stock is from the liquidation value of the company. That is from the difference between what you paid for the stock and the liquidation value even after the company has gone out of business. How does that work? In fact, as long as you buy the company's stock at a lower price than the liquidation value of the company, even if the company unfortunately fails, the shareholders can still get compensated at a higher price than their original purchase price. This approach was very early value investing method, and Warren Buffett also used this method to invest in stocks in his early years. It's a bit like picking up a cigar butt that nobody else wants and taking the last puff. That's why it's sometimes called cigar butt investing. Sounds like it's profitable to invest in penny stocks, doesn't it? However, as an astute investor, you cannot just look at the benefits and ignore the risks. The risks of investing in penny stocks mainly come from 3 aspects. Anticipation of delisting and bankruptcy. Penny stocks are usually companies on the verge of being delisted. These companies are therefore already in very poor shape, fundamentally speaking. For stocks like this that are facing delisting and bankruptcy at any moment, the share price will often plunge sharply. Speculators must bear the downside risk of stocks that will inevitably follow lower liquidity and lower investor expectations. The stock price is easily manipulated. Because of the low price and small trading volume of penny stocks, it often only requires one large investor with a sufficient amount of capital to make them fluctuate violently. As a result, penny stocks are very vulnerable to manipulation. Transaction cost. Because of the poor quality of penny stocks, they are, of course, not suitable for value investing. Therefore, most of the investors who trade penny stocks are speculators in the market, and more frequently than not, they make their investment decisions based on technical charts or just plain emotion, generating high transaction costs along the way. In some extreme cases, the transaction cost can be higher than the proceed of the sales eventually. So, those are the risks of trading penny stocks. In fact, when investing in US stocks, the risks are everywhere. In addition to the risk of speculating in penny stocks, there are 2 other common types of investment risk: margin risk and investment risk. Number 2, margin risk. Margin risk comes from the fluctuation of the share price. When the share price drops, the security value will drop as well. This could result in forced liquidation. If you don't understand why this would happen, it's very likely that you missed the part where we previously spoke about the following situations. Insufficient overnight excess liquidity. Sometimes Forced liquidation occurs because investors are unfamiliar with the trading rules for US stocks. In the Tiger Trade app, click Trade to see the remaining level of your overnight excess liquidity. Here, it is important to remind everyone to pay attention to the risk state of their investment account. In most cases, it is possible to proactively close a position by checking your risk status in time to prevent liquidation. For example, if your overnight excess liquidity reads safe or very safe, then you can breathe easily. But if it says dangerous or extremely dangerous, it means that your positions are close to forced liquidation. About 10 minutes before the close of each trading day, your broker will conduct an overnight excess liquidity assessment on your account positions. At this time, your overnight excess liquidity value needs to be greater than 0. Otherwise, some positions will be liquidated before the close. The short squeeze. Many investors like to short US stocks, but it must be noted that shorting is essentially a margin trade. In addition to checking the risk status on your account often, it is also necessary to be alert to risk of a short squeeze. Unlike borrowing money to buy stocks, short selling requires borrowing securities from a brokerage, and you have to pay a margin to the brokerage when borrowing. When against your expectation, the stock price goes up, your margin requirement will rise higher and higher, possibly resulting in your position being liquidated due to insufficient margin. Remember the short data we talked about earlier? When a stock with a high portion of shorts rises sharply, it is very likely that many holders of those shorts will rush to close their positions, which will cause those holders rush to get out and hence push the stock price to rise even further. This situation is called a short squeeze. For example, if you short a stock at $10, when the stock prices rise to $20, the account will be at a loss. At this time, you will be eager to buy the stock to close the position, and it is likely that you place a buy order of $21, which will further drive the share price up. This in turn will cause the risk control value of short account holders to trigger the closing of their positions, driving the stock up even higher. Compulsory recall. There is also another unpreventable risk, the recall of shares that have been borrowed in order to short them. This situation is not caused by insufficient margin in the account. It happens when the ratio of open short positions in a certain stock is extremely high and there is no shares left to borrow in the market. At this point, the lenders who originally held these shares may have to recall their shares for use in the balance of their own account, causing the broker to be forced to recall the shares from the investor who shorted the stock in order to return shares to the lender. What you need to know is that the relationship between the short seller and the leader is not equal, and the stock lender reserves the right to recall their shares at any time. In the event of a recall, brokerages typically try to find shares in the market to replace previously lent shares. But if there are no shares available to be borrowed and the lender issues a formal recall, the shorted shares will be recalled and the short seller will have to mark to market the losses, if any. This risk comes from a limitation of the securities lending business itself, and it's important that everyone should understand it. Now that you've learned about these types of market risks when trading US stocks, let's talk about investment risk. Number 3, investment risk. As long as it is an investment, there will be risks, which most investors can understand. Strictly speaking, investing in any market asset is risky. Investment itself endangers mainly 2 kinds of risks: systematic risk and unsystematic risk. Systematic risk. Systematic risk is also known as undiversifiable risk. Simply put, it is a risk that is outside the control of a company and cannot be avoided by diversifying a portfolio. If you think about it, what kind of risk is not diversifiable and is unavoidable? In fact, it's things like wars, regime changes, natural disasters, economic cycles, inflation, energy crises, macro policy adjustments, and so on. Systematic risks will generally adversely affect the vast majority of stocks. For example, if a severe crisis in the world economy or in the economy of a certain country occurs, if there is persistently high inflation, or if an extraordinary natural disaster happens, the consequences are universal. All stocks will fall, and it is impossible to persevere value by buying other stocks. The impact of systematic risk can be cross markets. For example, during the financial crisis in 2008, it wasn't only stocks that suffered heavy losses, but also safe haven assets like gold were sold off. Don't be nervous when you hear this. The modern economic and financial system are designed to reduce and mitigate the occurrence and the impact of systematic financial risk. Unsystematic risk. Unsystematic risk is a risk that is associated with a particular industry or company and can be avoided through diversification. For example, a change in regulation within a certain industry, the entry of a new competitor into the market, the discovery of a fraud in a company's financial reporting. So how can exposure to unsystematic risk be reduced? Quite simply, diversify your stock investments. Investment diversification means that by holding a large number of different stocks, the overall volatility of investment account is reduced, and there will be no huge changes in account balances due to excessive market volatility. To give a simple example, let's say you're optimistic about a company and you feel that it's financially sound and has great future potential. So you invest $1 million. Right after you put money in, financial fraud is exposed at the company and its shares lose 50% of their value. But what if you spread your investment over 10 different listed companies and invested only $100,000 in each? Then, if one of those companies encounters a crisis and loses 50%, even if the other companies don't make a penny, you'll only lose 5% over your overall portfolio capital, which is within your risk tolerance range. Of course, the advantage of diversification is to reduce unsystematic risk, but it will also make your returns more stable. If it turns out there's a dark horse hidden among your stocks, the worst thing that will happen is that you make a bit less profit because you diversified your holdings. Diversified investment improves portfolio's performance stability, especially in long run. Here is a formula that you can remember. Total investment risk equals systematic risk plus unsystematic risk. Even if systematic risk is difficult to control, as long as unsystematic risk is reduced, the total risk of an investment will be moderately reduced. Having a proper understanding of these types of risks can help you be well prepared to enjoy long-term benefits in the stock market. At this point, we've finished today's class. Now let's briefly summarize. Risks of investing in gross tickets, margin risks, investment risks. In this lesson, you learned about 4 possible types of risks associated with investing in US stocks. In fact, besides systematic risks that are difficult, if not impossible to avoid, the other 3 types of risks can be mitigated by improving your awareness of and diversifying your stock investments. So, in addition to the types of risks that I've mentioned above, what other types of risks might a listed company face? Find out in the next lesson. In the next lesson, I'll tell you about 4 situations that can cause problems for a listed company, and I'll teach you how to deal with these types of unwanted surprises. This knowledge will help you to potentially increase the success rate of your stock investments. I'll see you next time!